we're post-pandemic, right? You feel that in some ways the storm is behind you, and now all of a sudden you're hearing about this big R word, right? And when I say R word, some of you might sit up a little straighter and say, what is he talking about? And I'm talking about the word recession, right? So when you hear recession, immediately fear comes on you, right? Because the most recent recession that you've been through, right, is 2007, 2008, which they call the Great Recession, right? It's one of the worst recessions in the history of the United States. And as we, look at this, whether we're in a recession right now or we're not, a recession typically by definition is 2 negative quarters of GDP growth. And some indicators show that we've already had 2 negative quarters of GDP growth. So when we look at that, what we have to do is peel back the layers of the onion. We have to look deeper and say, how can we approach this? And we're doing that with clients already, right? How do we approach this? How do we benefit from this? And how do we utilize it for your advantage? That's the key piece. So when we look at the factors that we're facing right now, higher interest rates than we've seen in the last 10 years, right? They've increased rapidly. So when interest rates go up, things get more expensive, right? Think of a mortgage rate, for example. A year ago, a 30-year fixed mortgage was ultimately right around 3%. A 30-year fixed mortgage right now is right around 7%, right? A car loan, you were getting 0% financing on a car, right? People would say it's free money. I just had a client pay 7% with great credit. Now, some of you watching this, right, might have grown up in the 60s or 70s, and you're saying 7% on a car loan is extremely low compared to what we were paying in the 70s, right? But when we're used to 0% interest for the last 10 years, we become accustomed to it. And this is a different time, and that's why we're seeing a lot of these statistics jump at us or bite a little bit harder than it used to. So ultimately, when we look at the recession or we look at that keyword, a lot of clients say, what do we do? And I can tell you what we're doing and what we're having success with, right? Ultimately, when we look at a recession, you're insulating your income, right? You're saying, where can we draw income from where we don't have to worry about market volatility and we don't have to touch principal? The last thing you want to do is touch principal in a down market. If you're taking a 5% distribution, let's say from a portfolio, and let's say you're in mutual funds, and that mutual fund doesn't pay a yield or a dividend, you are selling 5% of your principal shares every single year. And if that holding is down, let's say 10, or in this case, maybe even 20 or 30%, that means you're compounding your loss. So if you sold 5% of the shares you owned, and the account was down 20%, that's a 25% reduction of principal, right, that you're seeing, and you had to sell those shares at a lower price, which means you sold more shares than you would have when the market was up. So that's step one. Do not touch principal, okay? Insulate yourself on the income that you need by you looking at different strategies or solutions that are out there. The second piece that we look at is how do you benefit from the volatility? The number one time to put in the market is when it's down. Nobody thinks about it. Nobody wants to do it. If the market's down, it's like going to the store and everything's on sale. If you would have bought the company pre-recession because you like the way the company is positioned, you should be looking at that same company during a recession because it's a better value to purchase it and you'll have bigger gains in the long run. Do not keep your scope on the short term. You have to look past this. So the number one thing we fail at as humans is we're stuck in the now, right? Gloom and doom. We're bombarded with news and media that is just negative, 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 but you have to look at the future. And if you're buying into a company that you're utilizing their product, and I want you to ask the question, if I utilize that product, I trust the company, I like their product, and I think they'll be bigger, they're probably going to be worth more money in the future, and that's something you want to look at purchasing because it's a strategic time to increase your wealth. More wealth is made during these times than is during an up market because you're doing your purchases during a low market to ride that gain out when the market increases. This is the time. The third thing we talk about is just making sure you're in the right investment vehicles for the appropriate times. So for example, one thing that we're trained typically, and this is not a typical market, one thing we're trained is in order to get more conservative, you sell your stocks typically and you would go more into fixed income. Well, right now we're in a rising interest rate environment. When interest rates go up, what do bond prices typically do? They fall, and they fall quickly. So do you want to sell out of something that's giving you more long-term gain to buy into something that's going to lose value quickly and give you less upside in the long term? Probably not. So you have to look at that. And most people in a 401k are in an age-based portfolio, or they call it a target fund. What that target fund is doing is the closer you get to retirement, they're selling your stocks and they're buying fixed income, which is going down in value, and you think you're taking less risk, but what's actually happening right now is you're taking more. So it's definitely a piece that you need to dissect and dive further into, and we are doing that right now. So looking ahead and looking at going through the recession, this is an opportunity to make sure you're positioned correctly, not only for now, but positioning your wealth to make you more wealth in the future with the market being down, but also solidifying that income to say, hey, I don't have to touch principal.